Assalamualaikum, Dr. Norda. So today, my name is Farhana. I will present my final project paper for the subject Game Theory Strategic Decision Making. So the title of my project will be Insurance Premium Increase Dilemma. Okay. So in this presentation, I will split my presentation into four segments. The first segment will be talking about game theory in insurance, the applications in insurance. So it will be a brief explanations on the applications of game theory in insurance. Second will be the definitions of the problem. So in the definitions of the problem, I will elaborate more on why insurance premium change or insurance premium increase dilemma can be translated into a game. Number three, we'll highlight or we'll talk further on the three key elements in game theory, which is player, strategies, and also payoff. So as for my segment four, I will discuss more on my analysis, talking about Nash equilibriums and also mixed strategy, the solutions, and also the discussions on the how to improve payoff, right? Okay, game theory in insurance. So for my research and reading, I found two very interesting papers written by Lemaire and also Warren et al. So Lemaire 1991, they actually utilize or applying the game theory applications, in his paper, he actually produced a survey paper on the applications of cooperative game theory in insurance. So in his paper, he explains, I think he lists what 2 to 3 cases of insurance. So one of the thing that I remember is that he applied the game theory to improve retention. Second is looking into the price change impact towards the competitor strategy. Okay, Warren et al. 2012, he also looked into the price change and the competition. Try to see if we increase the price or we lower down the price or if we change the price, how will it impact the strategy of the competitor? Okay, in general, game theory in insurance, policyholder and insurance company engage in a strategic interactions when negotiating and agreeing upon insurance contract. So, in the research by Lemaire and Warren, they pretty much having two different players, which is one company with another company. But I seldom see people that's talking about. There are some, but but don't really. It's not in details actually. They didn't really talk about the game between the policy holder and also the insurance company. So when you look into policy holder, their aim is to pay as little premium as possible while receiving a good coverage, while insurance companies seeks to maximize their profit by setting premium to accurately reflect the risk of insuring a particular policyholder. And game theory also can help the insurance company in so many ways. One of it is that, to encourage customer loyalty, in product, service, and also stay ahead in competitions. So let's just move on to definitions of the problem. Again, as I mentioned in the title, this game is about price increase or premium increase, premium increase dilemma, because it is a dilemma. Every month when each of the policyholder approaching the expiry date, so insurance company always face a dilemma because they not sure whether they should increase the policyholder premium or not. Why they need to do this? Because this is to mitigate the risk of high claim. So when high claim occurred, customer definitely will experience loss most of the time. So this is the main issues in insurance. And then, but ideally, when they have their analysis and all, they would like to increase price for the high risk segment. But sometimes this action can be misinterpreted, right? Maybe the model is not correct. They didn't have enough data to interpret the customer risk. Hence, sometimes they misinterpret the risk of customer, then end up they accidentally increase the premium for the low risk segment. So this is the problem here. Why this can consider as a game? Of course, it's a game of two players. We have the insurance company and also the policyholder. Second, it's a simultaneous game. Where both of the opponent or both of the player don't really know the opponent's strategy. It is uncertain for them. It is a zero sum game. I think because one player game is another player loss. I will explain in the payoff when I explain in the payoff. And third would be a non-cooperative game because both party definitely can't really discuss in detail, because it's very rare, seldom, where a policyholder or insurance company discuss about the price that they need to pay, for the premium. Okay, let's talk about the player of this game. Clearly, if you can see, the game is considered as a two-player game between insurance company and also policyholder, where each of these player will have two strategy. The strategy for the insurance player will be whether they want to increase the premium or don't increase the premium, while the the second player will be, which is the policyholder, will be the high risk or low risk segment. Okay, next I will talk about the payoff, how the payoff is defined. Okay. The payoff of this strategy can be explained by profit gain and profit loss. So when something happens, for example, when the insurance company increase the policy while the policyholder is high risk, are they gaining anything? Or it is a loss for them if they do that. So in order to interpret or elaborate more on the combinations of the strategy, the 4 by 2 of the 2 by 2 matrix, are split each of these combinations into four, which is combination A, combination B, combination C, and combinations D. So in this slide, I'll be elaborate more on how I define the payoff of player one, looking into player one perspective, how the payoff is defined. So when player one increase the premium while player two is high risk, which is good, because when they increase the premium, this is what they want. The premium, should be able to cover the cost of high claim. Hence, they are very happy with their actions. The payoff is going to be equal to one. Combinations B, looking into player one don't increase the premium, where the player two is high risk. And this is a very alarming event, something that they want to mitigate, because when player two is high risk, there is a very very high chance that the player or the policyholder will submit a high claim. This is definitely will contribute to a significant loss to the company. Hence, the payoff to the company is -1, because loss is going to happen. Looking into combination C, when the insurance company increased the premium for a low risk policyholder, yes, again, this is a wrong action, because when they increase the premium for a low risk, which is not necessary, right? They are a good customer. There will be a high chance that the policyholder will renew their policy with another company. Hence, this is definitely will contribute to a negative payoff. Looking into combinations D, where the company don't increase the premium to a low risk, which is what they want. Hence, there is a high chance that this low risk customer will continue to renew their policy with the company. The company will able to improve the volume of low risk customer in their database. Hence, the payoff going to be one. Looking into player two perspective in the next slide now, similar combination, similar manner, but this is player two perspective. Okay, so when player two is high risk, but player one you decide to increase the premium for this high risk policyholder, the best option for this high risk policyholder is just to accept, because there's no way they want they would like to decide to go to another company, because there is, when they are high risk, there is a high chance where their application is going to be rejected. So even though they are not happy, they have to accept it. Hence, it is a loss for the policyholder, because they need to pay extra. Hence, the payoff for player two, become when player two is high risk and the premium got increased, it's going to be -1 for player two perspective. Looking into combination two, they are a high risk segment, but end up the company don't really increase their premium. They're going to be very very happy, because they can enjoy the benefits, and if anything happen to them, they still can get fully covered with the lower premium. Hence, the payoff is going to be one for these combinations. Looking into combination C, when the policyholder, they are a low risk segment, but then the company is increasing their premium, which is not very much likely to happen, right? Then they because for them it doesn't really, this one doesn't really worth the risk because they're a low risk, since they seldom or never submit a claim before. So for them it will be better if they move on to a next company and try to get maybe a lower premium or a better coverage from another company, even though the gesture of increasing premium for the low risk, they are not happy with the current company, but then when they move to another company they are very happy, they can enjoy a better benefit and also maybe a better premium. Hence, the payoff for these cases when the customer is low risk and end up the insurance company is increasing the policy is still one for the player two because they is not losing anything, but end up they can really enjoy the same benefit, from another company. Okay, looking into combination D, when the policy holder is low risk, but then the company don't increase the premium. Okay, this is what's going to happen. The policyholder will continue, most of the time they will continue to renew the policy with the company, but there's a but there. Um, the premium is not increased. So they will renew, but it will be better if the insurance company reduce their policy due to the risk. Because there's also NCD. NCD is common, but they want to see reductions in premium, when they are a low risk customer. Because when they are a good driver, a claim will be not going to be highly occurred. Hence, because they are not happy, the payoff going to be equal to -1 for these combinations. So the final payoff table will look like this, right? So this is why I think the game is defined as a non-cooperative and a zero sum game of the two player. Okay, let's move on to the solutions. Talk about the Nash equilibriums. Looking into the payoff table here, the green circle is representing player to best strategy, and orange is representing player one. So looking into player one. So when player one increase the premium, hence the best that player two can do is to be a low risk. But when player one don't increase the premium, the best for player two is to be a high risk. But let's look into player two. So when player two is high risk, the best that player one can be is to increase the premium. But when player two is low risk, the best is to decrease the premium. So because there's no a stable state or a pure solutions for this, hence in this game there is no NE exists, since there is no stable state that can be achieved. Okay, next, looking into the mixed strategy. So when trying to solve the problem, with mixed strategy, since there is no final single strategy that can be concluded from the net and even the Nash equilibrium approach, and mixed strategy can be applied. Okay, this is the let's just assume that the representative of the probability, if customer increase, the probability increase is x, hence the probability of not increase is 1 minus x. So if the probability of high risk is y, the probability of low risk can be represented as 1 minus y. So this table is explaining the player one, by having player one pure strategy, what is the expected payoff from player two. So when we can compute the equations. So this one, when you try to solve these equations, let's just assume that when the player one decide to increase the premium, of course, the probability should be bigger than don't increase. And let's just agree on this non-equations, on this equation. Then we can solve this equation by getting the value of y, which is y is bigger or equal than 0.5. Similar to player 2, looking into the player 2 pure strategy and try to define the player 1 expected payoff, we can say that x is less or equal than 0.5 by solving these equations simultaneously. So in conclusion, for the insurance company, they can decide to increase the premium if the probability of customer being a high risk is more than 50%, which is represented by this. If it's more than y is high risk. If y is more than 50% occurrence, so they keep on seeing the high risk customer in the evaluations every month. Hence, they can decide to increase the premium. As for player 2, if the increase in premium occurred more than, or I think this one should be less than, sorry, less than 50%, then this is the time when the policyholder can can conclude as a high risk. So this is how we conclude the game. Okay, so after I complete the analysis, looking into the payoff, the Nash equilibrium, and also mixed strategy, we can see that the Nash equilibrium here can be achieved by uh, by computing the mixed strategy. So the mixed strategy can actually be concluded as the NE of the game. So the best solution for this game is that each insurance company and also policyholder, they need to play each of their strategy 50% of the time in order to get a better payoff. Okay, but when you look into the payoff and also the solution of this game, I can see that it is actually similar to the matching penny scheme. So matching penny scheme is a simplified versions of the rock, paper, and scissor, where it's about gain and loss, gain and also loss, right? So this game is similar to this because it's a zero sum matching penny scheme. When we refer to the journal written by one of the researcher on the matching penny scheme, it also conclude that um, the solution of this insurance premium, increase the dilemma can optimize when each player randomize their choice equally rather than reacting on the choice of opponent. So he also mentions that in his study, Hoffman et al. 2021, he said that in this study will generate approximately the same average payoff of both player 50 and 50, right, in their mixed equilibrium probability of 50%, which is the similar, what I've been concluding in my study as well. So how can each player improve their payoff? So one of the things that the insurance company can do is that maybe they can invest to some kind of AI. So there are an apps available online where we can install the app on our phone and they can really track our driving behaviors. This is an AI technology with some kind of gamifications, right? So if, for example, if they travel less mile, they can get discount because in one of the study, it had been mentioned that if we travel longer, we will have high probability to face an accident, right? So, yeah, so that's what happens. So if the insurance company would like to invest to this kind of technology, they will definitely able to improve their decision to determine whether the policyholder is high risk and low risk. As for the policyholder, what they can do is very simple, is to improve their driving behavior. When they improve their driving behavior, they can improve the risk from high risk to low risk. So thank you very much. That's all for my presentation. Assalamualaikum.